The Wall Street crash of 1929, also known as the Great Crash, was a major stock market crash in the United States that began in late October 1929. The crash marked the beginning of the worldwide Great Depression, which lasted until 1939. The crash is most associated with October 24, 1929, known as Black Thursday, when a record 12.9 million shares were traded on the New York Stock Exchange, NYSE, in a single day. On October 29, 1929, known as Black Tuesday, about 16.4 million shares were traded. The Roaring Twenties of the previous decade had been a time of industrial expansion in the U.S., and much of the profit had been invested in speculation, including in stocks. Many members of the public, disappointed by the low interest rates offered on their bank deposits, committed their relatively small sums to stockbrokers. By 1929, the U.S. economy was showing signs of trouble. The agricultural sector was depressed due to overproduction and falling prices, forcing many farmers into debt. Consumer goods manufacturers also had unsellable output due to low wages and thus low purchasing power. Factory owners cut production and fired staff, reducing demand even further. Despite these trends, investors continued to buy shares in areas of the economy where output was declining and unemployment was increasing, so the purchase price of stocks greatly exceeded their real value. By September 1929, more experienced shareholders realized that prices could not continue to rise and began to get rid of their holdings, which caused share values to stall and then fall, encouraging more to sell. As investors panicked, the selling became frenzied. After Black Thursday, leading bankers joined forces to purchase stock at prices above market value, a strategy used during the Panic of 1907. This encouraged a brief recovery before Black Tuesday. Further action failed to halt the fall, which continued until July 8, 1932. By then, the stock market had lost some 90% of its pre-crash value. The stock market crash crippled the American economy because not only had individual investors put their money into stocks, so did businesses. When the stock market crashed, businesses lost their money. Consumers also lost their money because many banks had invested their money without their permission or knowledge. The crash also caused chaos in the banking system as banks tried to collect on loans made to stock market investors whose holdings were now worth little or nothing at all. Many banks had themselves invested depositors' money in the stock market. When word spread that banks' assets contained huge, uncollectible loans and almost worthless stock certificates, depositors rushed to withdraw their savings. Unable to raise fresh funds from the Federal Reserve System, banks began failing by the hundreds in 1932 and 1933. The stock market crash of 1929 was a major turning point in American history. It marked the beginning of the Great Depression, a period of economic hardship that lasted for a decade. The crash was caused by a number of factors, including overproduction, low wages, and excessive speculation in the stock market. The crash had a devastating impact on the American economy, leading to widespread unemployment, poverty, and social unrest. The crash also had a lasting impact on American culture. It led to a loss of faith in the stock market and a growing distrust of big business. It also led to a greater awareness of the need for government intervention in the economy. The crash of 1929 is a reminder of the fragility of the economy and the importance of responsible investing. The crash also serves as a reminder of the importance of government regulation in preventing economic crises.